welcome to Berman's Call, right here on BNN Bloomberg. Larry Berman is here to take your questions on large cap stocks and on ETFs. You all know that number, 1-855-326-6266, or you can email Larry right now at bermanscall@bnnbloomberg.ca. Larry, thank you very much indeed for joining us. You're watching the Fed. What's going on there this week? Remind us.
Well, I'm at a conference actually in South Beach, and this is, we'll talk more about it at the educational part of the show. So for the next day or two, I'm really focused on the conference. But on Wednesday, we get the FOMC, and there's no expectation at all for any rate cuts. But we've seen a marketplace that went from pricing completely out rate cuts to the equity market weakness of the last few weeks, and now pricing in 3 rate cuts over the next year. Scott Bessent, Treasury Secretary, came out over the weekend and said, market volatility is not bothering us at all in terms of policy. So like we've been saying for a few weeks now, it's going to be a bumpy couple of months in front of us. There's a lot of policy uncertainty, and notwithstanding the markets primed for a bit of an oversold rally. It started late last week. It's continuing today. I expect it can continue through options expiry this week, but I don't see us going a whole lot higher than maybe another % or 2.
Do you think, would Jay Powell be interested in getting ahead of economic weakness caused by this trade war?
No, because if they get overly easy right now and inflation becomes a problem, that's going to be very difficult for them to roll back. So they're on hold. I don't expect a movement in either direction. It would take the equity markets falling, say, from here another 10% before they would be somewhat motivated to do that, before the wealth effect would start to impact consumer savings. So I wouldn't expect, tighter financial conditions to move the Fed right now. And really inflation with tariffs and everything still in front of us, tax cuts that Trump wants to put through. There's still a lot of inflationary risk to the economy that the Fed just can't ignore at this point.
Larry, NVIDIA is obviously a pretty useful bellwether for sentiment on tech/AI. Maybe we could put up a 1-month chart for NVDA. What's important here?
Well, now what's important today, Andy, is they have a big conference this week. Everyone's expecting Jensen to, deliver. And the challenge here is that NVIDIA, if you put up a 1-year chart, you can see for the last 3 or 4 months, it's just been chopping around, not doing much of anything. And while that is, it's not bearish, it's certainly not bullish. So what does it take to get the next leg up? And that is even better news than the market's expecting. You've seen a turnaround story being talked about in Intel. You're seeing competition from DeepSeek in the sense that maybe we don't need as many of these chips as we think we do. And so you've got a lot of uncertainty is my point. And it's going to be very hard to lift this stock, and a lot of the big AI names that have been run up, in the last year or two, out of their recent ranges. And so you're seeing a big rotation. Money is coming out of the big overvalued names, and it's going into the broader stocks. That is a very, very positive development, but it's very, very early in that too. So it's not all clear. Next bull market is here by any stretch of the imagination. But there will be a better opportunity, I think, later this year or early in 2026.
What about the big U.S. financials, Larry? Do they tempt you at all?
Not at the moment, because one of the things we're concerned about is weaker economic growth. Weaker economic growth is just not good for the financials, and that's not priced into the market at the moment. So we've seen in the last week a gaggle of street economists downgrade their growth outlooks for the U.S., downgrade their earnings outlooks for the U.S. They're always on average behind the curve. The market front runs, and these are well ahead of the marketplace. So we're in that part of the cycle right now where the street is chasing the market. If we were able to get a new rally going here to new highs, you could see them all start to upgrade their targets. I don't see that happening, though.
Larry, we are so glad to have you. Larry Berman is taking your phone calls and emails on large cap stocks and ETFs. And there's that number again, 1-855-326-6266. An email from Jerry. Can you recommend an ETF for consumer staples, blue chip covered call strategy, and a good dividend?
Consumer staples, blue chip covered call strategy. You know what? There's probably one, Andy, but I don't use it. So the ticker symbol isn't at the top of my head. There are a couple consumer staple ETFs, and the question is U.S. market, Canadian market. You get more breadth in the U.S., but typically they don't have a lot of covered call strategies in the U.S. market. So I don't have that off the top of my head. I'd have to look into it. And I would question this, because typically a covered call strategy is it's going to get a premium yield based on volatility. Consumer staple stocks don't carry a lot of volatility in general because of their nature. And so a covered call strategy on consumer staples typically isn't a good idea. And maybe that's why I can't think of a name of one of them, because maybe there isn't one.
Right.
Yeah.
I'm not coming across one at all. There is VDC in the States, Vanguard Consumer Staples, but I don't see any reference here to covered call strategy.
Yeah.
Okay, thanks for the question, though. We have an email from Scott. Could Larry comment on opportunities in Canadian and U.S. government bond ETFs for the medium term, specifically ZFL and TLT? I guess that would be maybe a longer term one, but Larry, I'm sure you would explain that. And would he prefer provincial bonds to federal bonds in the Canadian context?
Yeah, so good question. So ZFL is Canadian federal long bonds. FL is federal long bonds. TLT is Treasury long bonds. And so in context of trading and looking for a recession, those are great, both great vehicles. If you think there's going to be a harder economic landing, federal bonds are going to outperform provincial bonds as a rule of thumb. You're going to get a little bit more yield in a provincial bond in the long run than you are in a federal bond. So those are some of the dynamics. I think we're in a trading range for interest rates in general for the next few years, bound on one end by colossal amounts of debt that governments are going to need to issue, specifically coming out of the U.S., but really everywhere in the world. And then on the other side of it, you've got inflation, driving rates higher too, and then the prospect of a slower global economy, leading us into an economic slowdown at some point. So a lot of these they have both ways. So I'm playing it like a trading range right now. Most recently, we've been adding duration and maxing out our long bond exposure. But after the markets rallied a little bit, we're trimming that back. So that speaks to the nature of it. I wouldn't say buy and hold. If you were to see the U.S. 10-year get back to 4.75, the U.S. long bond get back to 5%, those are great opportunities for longer term trades. But right now, after the recent rally, I'm more neutral. I've taken my duration down in the portfolios.
Okay. Ryan is standing by in Saskatoon. Go ahead, Ryan, please.
Oh, hi, Larry. Thanks for taking my question. In general, your view on the price of oil and specifically Whitecap, if it's a buy at these levels with the recent Berman merger, and just the ability for Whitecap to manage oil tariffs. Thanks.
Okay, WCP.
Yeah, so the M&A activity is not my sweet spot. When Eric Nuttall's on next, ask him that question. I can tell you about the charts. I can tell you about the trading. I can tell you about the risk and return of owning a given name at a given price. So when you look at crude oil overall, I think best case scenario, we're range bound. I remember a few months ago or even a year ago when I said, no, oil's not going to break out here. We've got a slowing global economy. I would get hate mail from the people out west in Canada that don't want to hear that story. Now, having said that, oil's now at the bottom end of the range versus the top end of the range, and I like it down here. So I'm in accumulate mode on a lot of oil and gas names, but we're range bound. We're very unlikely to go into an environment where these stocks can start trending longer term higher. All of them, I don't care about the name, they're range traders in my mind. Now, if Whitecap has a very specific growth story to it, again, that's something Eric Nuttall will unlock for you, not Larry Berman, who's much more of a trader than someone who's thinking, 3 and 5 years into the future about a name that I might want to hold for growth potential.
Denise in Ottawa, go ahead, please.
Yes, hello, thank you. My first time calling.
Good, thanks.
My question is regarding pure play on gold in the TSX. I found 2 ETFs, ZGLD and ZGLH, which is hedged, unless you have a better recommendation. I'll hang up and listen. Okay. Thank you.
There's quite a few, Larry, isn't there?
Yep. Yeah, there are. And do you want to play gold bullion? Do you want to play gold equities? Do you want to play junior gold names? So there's a lot of different ways to play it. Someone actually sent me a study last week, which I knew the details on. But basically, gold bullion has outperformed gold equities over the past couple of decades by a wide margin. And I've been maintaining that gold equities are going to have their day in the sun at some point. And that just hasn't materialized yet. So it is a very interesting dynamic. I am longer term bullish on gold, but at $3,000 gold right here, I'm a little bit better seller and a little more cautious. I'd be looking to trim some exposure we have into strength as opposed to thinking it's going to break out and rally at this point. I've been saying for a number of months, buy the dip. I'm in that camp again, but right here at all-time highs for gold, it's more of a lighten up into strength than buy the dip thinking.
Okay, and gold, of course, above that 3,000 psychological mark in record territory once again. Let me just check if we are likely to get a gold. Looks like we are hitting a record high for gold once again today. Joe in Montreal. Go ahead, Joe, please.
Thank you, Andy. I want to ask Larry back to the oil story for a minute. I have ARC Resources for a long time in my core position as a gas play. And I also have a smaller position in the Global X Oil and Gas ETF, ENCC. And I wanted to ask Larry, should I be adding to, which of these positions I should be adding to at this time when oil is down? And I use this for my retired seniors account. I appreciate any help on that. Thank you.
Thanks.
Yeah, so I like the idea of adding on weakness into some of these areas. For sure. I've been doing that in our strategies. We use a lot of optionality in the portfolios we run for clients. So I'm writing puts, for example, in the energy sector to acquire companies. And if they don't go to those prices, I just earn the income. And I'm perfectly happy with a strategy like that at this point. There is a very real scenario that we get a harder economic landing at some point. And if that is the case, oil's got some more downside here. You may have heard the Oil Information Agency, Energy Information Agency in the U.S. Just downgraded their demand outlook for crude oil. Andy, you're the commodities guy. Maybe you can comment on that. But I see us in a trading range there, and I'm at this point at the lower end of the range into the accumulation into weakness.
Okay, and we got Anne in Scarborough. Go ahead, Scarborough, Ontario. Go ahead, please.
Hello, Larry. Why is Intel up, and should I take the money and run or hold? Thank you.
Thanks.
Well, Intel was one of the biggest positions in my portfolio for clients in the last year or two. We've been in and out of it several times. But if you look at a stock like this, I don't know how much history you could have here, but if you go back a long, long time, Intel's made no money for investors for 30 years. Now, unless you were a trader, and this is my point. So I really loved it at 20 and below. It was my biggest position. At 25, 26, I'm trimming it a little bit. At 35, I'm going to trim it again. If it gets above 40 at some point in the next year, I'll probably be out of it again. So there is a restructuring right now. And the question for the caller is, are you a trader or an investor? And if you're an investor in Intel, I feel sorry for you because it's been a terrible 30 years. If you're a trader, it's a great stock to trade. And that's how we approach a lot of the stocks in our portfolio. So I like it now. I loved it at 20. I like it a little bit less now, but it's still one of our bigger holdings. And we'll reduce into this area. And then again at 35, if we get up there by the end of the year, I'm going to trim again.
Thanks for that question. We have an email from Phil. I was looking at the concept of split shares, such as Brompton, DGS, and GDV. How do they work? What are the advantages and disadvantages? And can they maintain their high dividends?
Yeah, so they pay out a lot of income. So you got leverage in both of these, very concentrated stock portfolios, and they pay out a lot of income. There's a little bit of smoke and mirrors here, and when I say that, I'm not in a nefarious way, but you're getting 2-to-1 leverage. So these are twice as volatile in general as your underlying markets. And so when things are good, they're really, really good. And when things are bad, they're really, really bad. And so if you're okay with leverage in investing and you think the markets are going to go higher, you'll probably have a pretty good experience. But if you look at both of these ETFs over the last 2-3 months, where we've had a lot of downside market risk, it hasn't been very pleasurable at all. If you were to look at them compared to the TSX return or the S&P 500 return, you can see that, when the markets are going up, you get the magnification to the upside. When the market's correct, you get the magnification to the downside. So the question is for the individual, are you okay with that kind of ride? And if you are, then these are fine vehicles to approach the market. But if you're looking at the yield and saying, hey, these are great dividend payers, that is the very, very misleading part of it, because if you look through the underlying holdings, they don't pay those kind of dividends. So, you're getting a lot of the trading profits, you're getting a lot of the leverage in terms of how they're paying out to you. And there is a risk with the preferred side of these as opposed to the common side of absolutely losing your money. So they are for sophisticated investors. And don't be fooled by the yield component in terms of putting it in your portfolio and forgetting about it. Because when the markets get volatile, like they have been in recent weeks, you're not going to enjoy that experience very much.
Okay, we are going to have to take a break here. Larry's got his educational segment, and he's going to illustrate how the wealth management industry could learn from the giant pension sector when it comes to things like private capital. We'll be right back. Private credit, private equity. We'll be right back.
Berman is one of Canada's top technical analysts. He's the Chief Investment Officer of ETF Capital Management. To learn more, visit etfcm.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN, its parent company, or affiliates.
Larry's educational segment is on deck. Larry, take it away, please.
Yeah, so I'm at a conference on South Beach in Florida, literally on South Beach. It's on the sand. It's the coolest type of venue to do a conference, much more modern. But part of the modern thinking is, and why it's called future proof, is it's about what's coming next. And in the U.S., they're way ahead of Canada in terms of building portfolios and exposure to different asset classes. About a year ago, Andy, here on the show, I talked about moving my own personal portfolios into private equity and private credit. Mm-hmm. And I wanted to talk a little bit more about that today. So I prepared a graphic, and I've really compared it with 3 Vanguard balanced portfolios, VBAL, VGROW, VCNS. So it's 60-40, 80-20 40-60 in terms of balance. And over the last year, you can see the ups and downs and the swings on those three in terms of the volatility. Then I put the Cliffwater Corporate Lending Fund. So this is an investable fund only for Americans at this point. I had a meeting with them this morning. I'm talking with them about how to bring that into Canada. And then there's a couple other ETFs, BizD and PSP, which is private equity, public market exposure, and business credit, public market exposure. So all these ETFs and everything else, very volatile. They all go up and down like public market exposures do. And the question is, do you want something in your portfolio that looks more like that red line, where it's steady Eddie, not a lot of volatility, a lot more sleep at night? And so if that's something that resonates with you, we're really gonna try to open those gates. And part of why I'm down here is to find great investment vehicles that exist, not in Canada, in other places, and bring them into Canada. So really, really like the private market exposure and how that allows us to combine with public market exposure to ultimately smooth out the ride for investors. And I think as society ages and more people are not in their working years anymore and off their, living off their savings years, having that smoother ride in your portfolio like a Canada Pension Plan would do is really something that's resonating with more and more investors. And so, that for me, Andy, that's the next 10 years of my career, is really trying to find the right vehicles to bring them to investors in Canada.
It's interesting. Larry, we've less than a minute. Do you think people will be wary? In some cases, private investments are valued less often, and the value is harder, and they can be less liquid as well.
Absolutely. And the benefits then on the other side are the lower volatility. And so what's the trade-off? If you want liquidity every day in your portfolio, then the private markets maybe don't work. But at Q Wealth, we've built a private equity and a private credit portfolio that has daily liquidity for our investors. So it is possible to deliver, but you're typically not going to see this ever in an ETF format. It's too difficult by way of the nature of ETFs to make those liquid vehicles for public consumption versus for private use.
Larry, thank you very much indeed. Larry Berman returns every Monday at 3 p.m. Eastern Time. Going to hand you over to the close right after this.